Imagine waking up to find that every dollar you've saved, every investment you've made, has lost its value overnight. For millions during the Great Depression, this nightmare became reality, a catastrophe that redefined financial survival. Fast forward to 2024, where echoes of the past lurk behind rising inflation, volatile markets, and the everyday struggle to make ends meet. Are we really prepared to avoid history's mistakes? Or are we just one market crash away from another financial crisis? A crash heard round the world, then and now. The Great Depression's onset in 1929 wasn't merely a collapse of the stock market. It symbolized a systemic breakdown. The initial crash on October 24, Black Thursday, saw a record 12.9 million shares traded as panic spread. This sell-off worsened on Black Tuesday, causing a loss of about $30 billion in market value within days, roughly 10 times the federal budget at the time. This collapse triggered a domino effect as companies defaulted, laying off workers and igniting a severe banking crisis. Inflationary pressures and economic slowdown fears echo similar anxieties, especially after the collapse of Silicon Valley Bank earlier this year. The rise in credit interest rates today is a protective measure, yet it also mirrors past patterns of risk contagion, reminding us that regulations can mitigate but not eliminate financial instability. The gold standard's grip, a relic of the past? The gold standard, where currency was directly tied to gold reserves, limited the ability to expand the money supply, causing a chain reaction of deflation. As the Depression deepened, people exchanged their cash for gold, fearing for their savings. This drained reserves and forced the Federal Reserve to maintain high interest rates, worsening the recession. In contrast, 2024's central banks are unencumbered by such limitations, allowing for dynamic monetary policy. However, the pandemic-era stimulus revealed a downside. Rapid money printing fueled inflation, making the dollar's value more susceptible to economic swings. Despite recent rate hikes, inflation persists, showing us that removing the gold standard was only a partial solution. Bank failures, then a flood, now a drip. The 1930s banking crisis was marked by extreme distrust in financial institutions, causing mass withdrawals and the failure of over 9,000 banks across the U.S. This panic stemmed from bank assets, heavily invested in loans and stock market securities that had drastically dropped in value. In 1933, the Federal Deposit Insurance Corporation was created to insure deposits, restoring some public confidence and curtailing future bank runs. And while bank failures are rare compared to the Depression, the collapse of institutions like Silicon Valley Bank this year underscores the fragility of smaller banks that are heavily reliant on specific sectors, like tech. Today's inflationary pressures and higher interest rates also increase loan defaults, placing additional strain on bank assets. Although the Federal Deposit Insurance Corporation now insures deposits up to $250,000, the high debt burdens and cost of living increases test the stability of even insured banks, highlighting the ongoing importance of strong regulatory oversight. Unemployment lines and the gig economy. At the Depression's peak, 1 in 4 Americans were jobless, creating visible lines of people seeking food and shelter assistance. Government relief was scarce, with many people relying on charities and Hoovervilles, makeshift shantytowns named derisively after President Herbert Hoover. By contrast, the modern workforce has shifted toward a gig economy where many workers, though employed, lack job security and benefits like health care or retirement savings. Platforms like Uber, DoorDash, and TaskRabbit offer income opportunities, but at low wages that fail to keep pace with rising living costs. According to recent studies, nearly 36% of U.S. workers now participate in the gig economy, many as a second income source to offset inflation. This economic model, while flexible, often leaves workers without the safety net that traditional jobs provided, resembling Depression-era economic insecurity in a new form. High stakes, higher interest rates, then and now. The Fed's decision to raise interest rates during the Great Depression to retain gold reserves made borrowing extremely expensive, hampering business investments and consumer spending. This policy exacerbated the economic downturn, which took years to stabilize. In 2024, The Federal Reserve has been aggressively increasing rates to manage inflation, which, while easing price hikes, has made essential loans costly. The current 30-year mortgage rate, for instance, is above 7%, deterring potential homeowners and driving up rental demand. Additionally, total household debt has reached over $17 trillion, with credit card debt crossing the $1 trillion mark, an all-time high in U.S. history. These economic pressures restrict consumer spending, similar to the effects of the 1930s policies, suggesting that while rate hikes control inflation, they can also significantly affect household budgets, especially with today's high costs of essentials like housing and food. Family finances, the squeeze on savings. During the Great Depression, families across America faced severe financial hardships as incomes vanished and wages dropped drastically, leading to a frugal lifestyle where every dollar counted. Many had to make difficult choices, forgoing basic necessities like new clothing and household repairs, and they became adept at repurposing items. Fast forward to 2024, where inflation has consistently outpaced wage growth, pushing families to dip into their savings or rely on credit. As of recent data, the median American household savings has declined by over 25% since pre-pandemic levels, and the personal savings rate fell to around 3.5%, close to historic lows. Rising costs for essentials, particularly housing, groceries, and healthcare, have stretched budgets thin, reviving Depression-era habits like strict budgeting and eliminating luxury spending. This financial squeeze underscores the timeless importance of emergency funds and careful spending strategies as key foundations of household stability. Government intervention, a balancing act. Franklin D. Roosevelt's New Deal in the 1930s introduced massive public projects and reforms to kickstart the economy. From Social Security to labor rights, these measures reshaped the American economic landscape. In recent years, stimulus payments and infrastructure bills have served a similar purpose. However, high government spending has fueled inflation, prompting the Fed to raise interest rates in response. Balancing stimulus and inflation control is challenging. Spending supports jobs, but unchecked inflation erodes purchasing power. The lesson remains. Government intervention is essential, but must be managed carefully to avoid long-term consequences. Public works. Then shovels, now stimulus checks. Public works programs, like building highways and dams, provided jobs and helped lift the U.S. out of the Depression. These jobs offered stability, albeit with low wages. In 2024, economic stimulus includes tech-focused programs and infrastructure investments. But today's economy demands digital skills, creating a gap between available jobs and the workforce's skill level. Learning from the past, policymakers are emphasizing training in fields like renewable energy and technology, which could reduce job insecurity. Bridging this skill gap is critical for a sustainable recovery in the modern age. Inflation, when new money fails us. In the 1930s, deflation was the problem, with prices falling as demand dried up. However, today's problem is inflation, exacerbated by pandemic-era stimulus and supply chain disruptions. The Consumer Price Index in 2023 showed price increases across most sectors, and although inflation has slowed, prices remain high. To control this, the Fed has raised rates, affecting loan and mortgage rates. This has cooled spending somewhat, but essentials like groceries and rent remain costly. Historical insights remind us that economic measures take time, and patience is essential even if costs remain high. Personal resilience, make-do spirit reborn. The Great Depression fostered a make-do spirit. Families grew their own food, repurposed clothes, and found creative ways to stretch resources. In 2024, this spirit is resurfacing as more people embrace frugality. Gardening, thrifting, and meal prepping have become popular as inflation pressures household budgets. Many have adopted money-saving tactics, reminiscent of Depression-era resourcefulness. The lesson is clear. Resilience is timeless, and financial hardship can inspire creativity. History shows us that challenges, though tough, often bring out our most innovative and resourceful sides. Thanks for joining us on this journey through one of history's greatest financial crises and its lessons for today. If you found this video helpful, give it a thumbs up and don't forget to subscribe for more future videos. Hit that notification bell so you never miss an update. Until next time, stay informed and stay prepared.